prop firm challenge made me over 5 figures and helped me pass 7 $100,000 prop firm challenges. And in today's video, I'm going to share with you for completely free exactly how I approach my challenges, exactly what my strategy is, and everything that you need to know. Let's not waste any time. Let's get right into it. So when it comes to trading, everybody likes to focus on technical analysis, but I am a really big believer in fundamentals. The largest institutions, the largest hedge funds in the world, they're not just looking at the charts, they're obviously looking at the catalysts that are moving the market. So if you take one takeaway from this video, it would be to try and implement risk on and risk off analysis in your trading. If you want to make the most amount of money, you need to know how to combine a weak currency with a strong currency. You don't want any of those, sideways consolidation assets to be trading. You really want something that's moving. That's how you'll make the most money. And to do that, you need to understand risk sentiment, which we'll touch on a little bit in this video. But obviously, many of you watching, you are chart addicts. You like the charts. And so I'm going to show you the exact technical analysis system that I believe literally anybody can implement. Your 10-year-old cousin, nephew, niece, son, I don't know who you are, could implement. It's very, very simple, okay? So one of my main philosophies is quality over quantity. And so I always start my analysis from the daily charts. I really don't go below the 30 minutes. Sometimes if I'm really trying to refine an entry, I could maybe look at the 15-minute, but those higher time frames are going to give you fewer setups. The quality of those setups are going to be much, much higher. Okay, so when we're on the daily chart, what we first want to do is this is gold. This is one of the most popular at Lark Funding. I ran some numbers to see which asset's the most popular. It's gold, so we're going to run the analysis on gold. On the daily chart, what I like to do first is I like to put all of my key levels. Now, if you think this looks simple, that's because it obviously is, but we're going to refine it a little bit as we go. So on the daily chart, I'm looking for the areas where there are the most touches. I don't want to overcomplicate it. Again, if ever in doubt, ask yourself, what would a 10-year-old point out? How would they draw these lines? I'm not looking to go in on a microscopic level and then refine them further. Okay, there might be something. Gold's actually at an all-time high of 3,400, so we won't have any key levels above what we already have. But here is where it gets a little bit unique. What I then want to do after throwing on these key levels is I want to adjust them to be a psychological level if possible. As humans, we like round numbers. It's kind of just how we think, it's how we operate. There's a lot of psychological levels and psychological things when it comes to trading. And so whenever possible, I want to turn these key levels into round number psychological levels because it's going to make it that much stronger. So in order to do it, what I do is I double click on the line and I ask myself, what's the closest round number where when I adjust it on the chart, it's still valid? This one's really, really easy. 3,503. So obviously we would round down to 3,500 and you can see the line barely moves. So that is now our key level / round number / psychological level. So it's that much stronger than just a basic key level. Okay, it's 3,430. When it comes to gold, obviously the higher the round number, the better. Like 3,430 is a round number, but if possible, it would be cool to do it like 3440 or 50 would be good. I mean, if we put 3450, you can see it's no longer valid. It's no longer on the candle. So we're going to keep it at 3430. Next up, we have this touch right here, which is at 3161. So I'm going to put it 3160. We're then going to come down here to 2960, which will work quite well. You could see here we have these touches, these clean touches right here. For this guy over here, 2790. So we're getting easy numbers for this video, which I suppose is nice. 2584. So let's round it to 2585. You could see it still works. What happens if we go down to 2580? It still works as well. If we go back to 2585, I think we get this touch here a little bit better. It's a little bit cleaner. So what do? We, on the daily chart, we put our key levels, the areas where there are the most touches. We then look to see if we can put it, if we can round it to a round number to turn it into a psychological level. And that's what we have there. Next step is to do the exact same thing, except the round number part on the 4 hours. So we want to see, are there any 4-hour intra key level areas? And to do that, we're going to use a dotted line. So we'll put this as a dashed line. And again, what we're looking for is we're looking for the most amount of touches, ideally not cutting the wicks. But again, so should I keep it like this? Or if I raise it up, you see how I now have the touch of this candle, okay? And almost the touch of this one. So again, key levels, it's not always an X price. Yes, we use the round numbers as psychological levels to try and tighten things up, but it's not always a set price. It's an area. That's why you call it a key level. It's a level. It's an area where price reacts. It's not a hard science. So we are trying to just get as many touches as possible. And we could throw another one down here. Then if we look over to this guy here, we have that touch, this touch, that one. So that's quite nice as well. And in terms of what's relevant for the current price action, well, this is kind of it. So I like to have 2 to 3 intra key levels between our daily levels so that I can really look at those areas quite easily and know where price might react. Next step, what we want to do is, I'm not a huge trend line trader, but sometimes they can be quite powerful. And so again, I don't want to ever zoom in, try and force things. I want to look for the most obvious levels, the most obvious trend lines. And so I can see a couple that are already forming. So we've got this guy right here. When it comes to trend lines, how do I draw them? Do I cut the wicks? I never cut the wicks, and I'm going to tell you why. It's actually quite important. If we were to cut this candle and we were to come here, all of a sudden your third touch is about here. So let's say you were to take a short here and you were to have your stop loss, I don't know, somewhere around there, because that's what the trend line is. You could get stopped out. Whereas if you actually had it like this, your entry point would have been completely different. Your stop loss would have been completely different. And so you're really trying to avoid all those potential fake outs. So when it comes to trend lines, you do what you want, but I never cut the wicks. When it comes to trend lines as well, whenever I have a clear one, I always try and clone it to see if we could be in a clear channel, which more often than not we are. So you could see here, when it comes to channels, I'm a little bit more lenient. When it comes to the wicks, we're not trading just off of that counter trend line. So I'm a little bit more flexible in regards to that. But we are clearly in a sideways channel, downward channel, whatever you want to call it. Labels are kind of a waste of time. Aside from that, we want to do the exact same thing on the daily chart. If there's any clear trend lines, again, we're not forcing anything. Ideally, a 45-degree angle allows it to be sustainable. If it's anything too steep, if we've got something like this, the market's obviously going to have to break through it eventually. And this is getting kind of close to a 45-degree angle. I don't love it though, because this is just super choppy. We did get these 2 bounces, but for me, that's not relevant. I'm always looking, when it comes to trend lines, a third touch. So yes, you could have a 4th touch, a 5th touch, but beyond a 3rd touch, every touch you get becomes more likely that the market is going to break it. So I prefer 3rd touches. Now, if you are enjoying this video, I know I'm going a little bit fast. There is a free Skool community down below. I'm all about giving away everything I possibly can for free. And I think there's 10 or 15 hours worth of free trading courses on my entire strategy, completely free. It's down below, so you can always join that. So what do? We are looking for the most major highs and lows, and we're going to draw our fibs, which I'm going to keep it clean for you guys. What do we use? We use the 0 and 100, obviously. We use the 23.6, the 38.2, the 50, which, fun fact, isn't actually a fib level. That's just a 50% retracement, so it still works very well. 61.8, 78.6, and 88.6. Now, the most important ones, if you want to just take something very easy from this video, 38, 50, 61. You can ignore the rest. Okay, 23.6 is only good when the market's really trending. So the market's really trending, you want to get in on a pullback. The market's not always going to retrace deep enough to the 38.2. So the 23.6 can be quite valuable, quite helpful. For me, sometimes if we break through the 61.8, the 78.6 could be kind of a nice bounce. Everyone's got their orders at the 61.8. Everyone expects a bounce at the 61.8. So sometimes we actually do get some action off the 78.6. And in that case, I would use the 88.6 as my stop loss. You need to ask yourself, what would a 10-year-old point out for the major high and the major low? Well, there's a couple here, which makes it complicated, but also makes it powerful. So you have this low here. We draw it from the high to the low. You have another one, and yes, let me try and put a couple of different colors. And then you have another one right here, right? So this is an obvious low. We draw it from the low to the high, and let's make this one red. So at this point, the chart's getting a little bit messy. You're probably asking yourself, how the heck do I take a trade? Very, very simple. And that's why I love this strategy. That's why this strategy was incredibly effective for my passing of FTMO challenges, prop firm challenges. Everything that I have done, you're going to use independently, meaning you're not trying to draw a fib with your trend line. You just say, okay, I'm going to draw my trend lines. I'm going to draw my key levels. I'm going to put my fibs. Then all you're doing is you're looking to see where they line up. Okay, that's it. And when it comes to where they line up, you want to find areas where there's 2, 3, 4. The more, the better. You're going to throw a pending order on there, and that's going to be your trick. Okay, so obviously I'm going to continue to show you, continue to break it down. But in a nutshell, right, the Spark Notes version, that is how I trade. Just if we take a quick little break here, you can already see this area right here. What do we have? Well, the yellow was the major fib, so we have the 38.2. The red is the 61.8, and this white line is the round number key level. So we already have 3, arguably 4, because we might even have this trend line here. So as you can see, this becomes really an area of high interest. What do? I draw a green box so that I know what's going on. And if I wanted, I could do a little text box and I could say, these are the confluences, because I like to keep things simple. Again, so I'm going to delete everything eventually and just have those zones. So if I want to remember, kind of a personal preference, you could trust yourself and know there's a reason to have that box, or you could write down what the confluences actually are. So beyond that, that is area number 1. Area number 2 is 78.6, this red one, the 50, and well, not the 88.6, because then that's the next fib, but you have this 4-hour key level, okay? So this becomes an interesting level as well. However, now we start to get into the execution side of things, which again, in that Skool community, there's like independent videos just on execution. So if you're overwhelmed, that's completely normal. I'm going through a lot. But what you can see here is this zone is 30 pips, which is not too bad for gold, to be honest. It's not too bad at all, but it's larger. So what we want is we want as tight of a zone as possible. We want all of the confluences to be as close together as we possibly can. Why? Because that's going to allow us to have a tighter stop loss, and that's going to allow us, therefore, to have a larger risk to reward. So as a general rule of thumb, when it comes to stop losses, it needs to be the size of my zone plus half, times 1.5. So if we have a 30 pip zone, the zone is measured from the first confluence to the last confluence. If the distance between my first confluence and the last confluence is 30 pips, 30 times 1.5, I don't do math in public, but I'm pretty confident that is 45. So my stop loss in this case would be 45 pips. This gives me enough breathing room. It gives the trade enough breathing room for the market to determine whether or not it wants to actually move from this zone. Now, what's really powerful about this strategy, this approach, is you'll often get, as I've shared on this channel, on my Instagram over the years, you get a ton of sniper entries, which is really, really fun. It's good for confidence. And rather than holding a trade for hours and hours or days, not knowing whether or not it's going to work, you find out pretty quickly with these setups and this strategy whether or not it's actually going to work for you. So you can see here our stop loss would be 45 pips. So for example, just to visualize it, we would set a pending order just a couple of pips before the first confluence. Then we would set our stop loss at 45 pips. Now again, it's gold. So the more breathing room, the better. But again, we're always going for setups that have high probability. In terms of risk to reward, well, you're going to aim all the way up here. So, a risk to reward of 9.5 is pretty standard for me. Don't listen to a word that I said, because I'm obviously joking. If anybody is telling you 10 to 1 risk to rewards is normal, it's absolutely not. So no, this is not what we would be going for. Obviously, there's a chance, of course, that the market could rally back up to all-time highs, could break through 3,500, of course. But are you going to hold it for that long? Are you going to hold it for weeks, months? Most likely not. You're looking to pass the prop firm challenge. You want to make money relatively quickly, I imagine. So no, just run away from all those traders that say, 9.5, those Instagram screenshots, it's crazy. No, minimum risk reward is always 1-to-1. Now remember, if you take one thing from this video, please let it be this, because it took me years to figure this out, years to learn this, and it helped me tremendously. There's an inverse correlation between your win rate and your risk to reward. In simple terms, what does that mean? It means if you want to win a lot of trades, if you want to have a high win rate, every win is going to be smaller. Your risk to reward needs to be smaller. If you want to have huge wins, if you want to have a really large risk to reward, your win rate is going to be very low. If you want to win 80% of your trades, well, your average risk to reward might be less than 1-to-1. But if you want your risk to reward to be 5-to-1, you might only win 10% of your trades. Now, it's just numbers. There's not a right way or a wrong way to do it, but as humans, we're pretty emotional. I haven't really seen a lot of traders that are able to successfully trade with a 10% win rate or a 20% win rate. Just psychologically, it's very difficult. So for me, I rather win a lot of trades, and I'm more than happy for those winners to be small. So minimum risk to reward is always 1-to-1 for me. And that doesn't mean I might not hold it for longer. I might take profit and then let it run, but minimum 1-to-1 risk to reward. And that allows me to have a high win rate. If I'm on the daily chart, 60-65%, I think is pretty realistic to see. Okay, so in this case, our 45 pip stop loss would lead to a 45 pip minimum take profit right there, and then we would target higher levels above. Okay, so you now have seen how I approach the charts, roughly how I take a trade, how I set my stop loss, to set my take profit levels. Another note on take profit levels is you want to ask yourself, if you had to take a trade in the opposite direction, so if we're in a buy and you had to take a sell, where would you enter that sell? The answer is where you want to take profit, at least some off the table. Very simple, but it helps me a lot. One thing that we did not cover that I probably could not trade with is moving averages. So we're going to throw those on here. And how do they work? How do we use them? We use them the exact same way that we use all of our other tools. They are just another confluence. We use them independently, and we look to see where they line up on our chart. So you could see here, this red one, which I believe is a 50 or a 100-day moving average. This red one here, it's lining up absolutely perfectly with the 61, the daily key level, and the 38.2. Now, as implied in the name, they are moving. So the odds of this still being here when the market comes down and hit it is probably pretty slim. So I won't count this as a confluence unless something happened, Trump tweets something, the market melts, and it's still here. But you have to remember that they're moving, so the timing doesn't always work out perfectly. Whereas you could see here, this blue one, which is the daily, you could see that it's still below our zone. So there's a good chance that this might actually line up if the market does come down. So just kind of an important way to think about things. Now, as I said, you want the zone to be as tight as possible. So what happens if you have a bunch of confluences, but your zone's a little too wide? Again, as another important side note, all kinds of side notes because I'm going through things quickly, but as an important side note, I never have a stop loss larger than 50 pips. For me, I just don't like it. It leads to me holding the trade longer than I want. Again, I want those sniper entries. That doesn't mean there's anything wrong with having a stop loss larger than 50 pips, but if you're like me, what that means is you need to refine your zone. If you need to determine what confluences do you actually want to take into consideration when taking the trade. So what does that mean? Let's say here, this green box, it's 30 pips we said. What if we wanted to make it tighter? I could lower it here and say, I'm going to ignore the 78.6. I'm going to focus on the 50 fib, this 4-hour key level, and maybe if we're lucky, this 100 moving average will line up with it. Is that fine to do? It is absolutely fine to do, because what it means is it reduces your stop loss from, okay, your zone now is 16 pips. That would be a 20-something stop loss. Again, it's gold, so I probably wouldn't do that. I would reduce my stop loss from 45 pips to 30 pips. On gold, I never go less than 30 pips. What does that mean though? What does it mean for you? It means that your risk to reward will be better. It means that your stop loss will be smaller. Obviously, your risk to reward will be better. But it also means that there is a higher chance that you are not going to get into the trade. There is a chance that the market could come down, hit the 78.6, and start to move without you. Now, you have to be willing to live with that. So if you have the larger zone, the odds of you getting into the trade are higher, but your risk to reward is worse. If you tighten up your zone, your risk to reward improves, but the odds of you missing this trade are higher. A bet that is a situation that I can live with. It's worth the potential higher risk, the better setup, in my opinion. But you have to have the discipline to be watching the chart to see that it's moving, to see that it hit the 78.6, it's moved without you, and you have to cancel your pending order. It's heartbreaking to see something come within 5 pips of your pending order and move exactly how you wanted it to and not get triggered into the trade. It's heartbreaking, but you have to have the discipline then cancel the trade. This is everything that we did on the daily. Everything that I did, including the moving averages, it works on low time frames. It works on the 15-minute chart. It works on the 5-minute chart, but you're going to get a lot more noise. So remember, the higher the time frame, the higher the quality of the setup. The lower the time frame, the more setups you're going to get, but the quality of those setups is lower. They're not as strong. Now, if we were to jump down onto the 1 hour just to take a look at things, we can use this to further refine our entries. You could see here this purple line that moves quite sideways. I like a lot is the 800-day moving average, and it's really powerful across all time frames. Now, you can again use everything that I just showed you on lower time frames. So if you wanted to start to stack some fibs, you could draw one from up here, right? You could draw another one here, and you can look to see where they line up. Do they line up? The 38.2 and the 23.6 work, but you could see the market already used it. You can't use a zone that the market has already reacted to. It's shown that your zone worked, but the liquidity has been grabbed. It's too high risk for me. So maybe I would want to refine it a little bit more, but this area here is looking interesting with the 61 and the 38.2. Now, I know what you're thinking. I can already hear you in the comment section. Oh my gosh, the chart is so messy. Yes, it is messy, but if you just have a little bit of patience, you'll get used to it. And again, we're not going to keep it like this. If we go back onto the 4 hour, what did we do? We drew our boxes. We have 2 potential buy zones here. So do we need to leave anything on the charts? No, if you want to keep it super clean, super sharp, whatever you want to call it, you can completely leave it. How do you know whether to buy or sell? That's when it comes down to risk sentiment. How do you know what assets to be trading? Should you be watching all of these? Should you focus on 1 or 2? That all comes down to risk sentiment of understanding why is the market moving the way that it is. This strategy, this approach is very, very simple, yet it's powerful. But there's another piece to the puzzle, which is a fundamental analysis, understanding why your thing's moving the way that they are. And that's where Pip Munch comes in. It is the #1 daily market newsletter for traders. If you're a trader and in 5 minutes every morning for 100% free, you want to understand why the market is moving the way that it is, what's going on in the world, why did Euro USD crash, why is gold doing this, why is Bitcoin doing that. In 5 minutes every single morning, we write this email, we send it out, and so that's my pitch for today. Over 27,000 traders trust it. It's really fun, it's really casual, but it's the newsletter that I wish I had when I was first becoming a trader. So I hope you subscribe to that down below. It's completely free. If you have any questions, drop them down below. I'll do my very best to answer all of them. This was a fun little video. I hope you're not overwhelmed, but I hope you got something from it. And as always, I will see you in the next one.